Imagine waking up to a global market crash, seeing your portfolio drop by 30% in a single week, yet feeling absolutely no panic because your bank account just grew anyway. Most investors are currently walking a tightrope over a canyon of inflation and volatility, blindly trusting an ancient mathematical formula that was never designed to survive the chaos of our modern economy. The financial industry has sold you a comfortable lie called the 4% rule, promising that your savings will last forever if you simply sell off small pieces of your nest egg. But what happens when the market stops growing, the cost of living doubles, and you are forced to sell your hard-earned shares at the absolute bottom just to pay your monthly bills? The reality is that traditional retirement planning is a ticking time bomb, and the fuse is burning much faster than you realize, leaving millions of retirees vulnerable to total financial depletion. Today, we are dismantling the old myths and revealing the only strategy that transforms your portfolio from a shrinking pile of cash into a self-sustaining, ever-growing engine of pure passive income. If you want to stop praying for a green market and start getting paid regardless of what Wall Street does, you need to understand why the old rules are officially dead today. My name is Dave, and here at the Dividend Lab, we focus on building wealth that lasts generations. So please hit that like button and subscribe to join our growing community of investors. Before we dive into the data, I have a question for you. If the market stayed flat for a decade, would your current strategy allow you to sleep soundly or cause total panic? Share your honest thoughts in the comments below, because understanding your specific psychological reaction to a sideways market is the first step toward building a truly bulletproof and resilient financial future. The 4% rule originated in the 90s, an era defined by high interest rates and a booming bond market that simply does not exist in our current inflationary and volatile global landscape. When William Bengen first proposed this withdrawal rate, he was looking at historical data that assumed bonds would yield enough to offset the constant selling of equities, which is no longer true. Today, inflation eats your purchasing power while low yields force you to take massive risks with your principal, just to maintain the same standard of living you enjoyed only a decade ago. The biggest threat you face isn't a market crash itself, but the sequence of returns risk, which occurs when you are forced to sell assets during a prolonged and nasty market downturn. Selling shares when they are down 40% is financial suicide, as it permanently reduces your share count and prevents your portfolio from ever fully recovering when the market eventually turns around. Relying on capital appreciation is essentially a gamble on timing. You are betting that the market will always be up exactly when you need to pay your mortgage or buy your groceries. Furthermore, every time you sell a stock to generate cash, you trigger capital gains taxes and brokerage fees, slowly eroding your wealth through 1,000 small, painful cuts that most people ignore. Traditional advisors love the 4% rule because it keeps you dependent on their management, but it leaves you exposed to the whims of a market that does not care about you. We must shift our perspective away from the total paper value of an account and toward the actual tangible cash flow that the underlying businesses are producing for us every single month. If your retirement depends on the kindness of strangers willing to buy your stocks at a higher price, you aren't an investor. You are a speculator waiting for a very lucky break. Dividend stocks represent a fundamental shift in power, moving you from a victim of market fluctuations to a part owner of profitable enterprises that share their success directly with you in cash. When a company sends you a dividend, they are providing a literal return on your investment that does not require you to give up your ownership stake in the business at all. This creates a psychological fortress. While other investors are panicking over red charts, you are focused on the dividend check that arrived on time, just like it has for 25 years. High-quality dividend growers are usually mature companies with dominant market positions, meaning they have the pricing power necessary to raise their payouts even when inflation is running rampant through the economy. Think about companies that provide essential services. People will always pay for electricity, healthcare, and consumer staples, regardless of whether the S&P 500 is up or down on any given day. By owning these cash cows, you are building a bridge over the volatility, allowing you to ignore the daily noise of financial news and focus on the growth of your income stream. You never have to worry about market timing, because the goal isn't to sell the stock at a peak, but to collect the increasing rent that the stock pays you for holding. This preservation of the core principle is the ultimate safety net. Your golden goose stays alive and healthy, continuing to lay eggs while the neighbor is forced to cook theirs for dinner. Dividends also act as a powerful filter for quality, because a company cannot fake cold, hard cash payments to shareholders the same way they can manipulate earnings reports through creative accounting. True security comes from knowing that your lifestyle is funded by the labor of thousands of employees and the profits of global corporations, rather than the volatile emotions of panicked retail traders. Let's look at the cold, hard numbers. A portfolio yielding 4% in dividends grows very differently than a portfolio where you manually sell 4% of your holdings every single year. In a flat or declining market, the person selling shares is shrinking their engine, while the dividend investor is actually buying more shares at a discount if they choose to reinvest. This creates an exponential growth curve. As you accumulate more shares through reinvestment, your next dividend payment is even larger, which then buys even more shares in a beautiful, virtuous cycle. During sideways markets, which can last for a decade or more, capital gains investors make zero progress, while dividend investors see their annual income rise year after year through consistent growth. We have analyzed metrics showing that dividend-paying stocks historically outperform non-payers with significantly lower volatility, providing a much higher margin of safety during the most prolonged and painful economic recessions. The math proves that a yield-focused strategy provides a floor for your portfolio value, as value-oriented investors will eventually step in to buy the stock once the dividend yield becomes too attractive. Consider the yield-on-cost metric. If you buy a stock today at a 3% yield and they raise the dividend annually, your actual personal yield could hit double digits eventually. This is the secret sauce of wealth. Your initial investment stays the same, but the cash it produces grows so large that it eventually covers all your expenses and then some more. Manual withdrawals are a subtractive process that fights against the power of compounding, while dividends are an additive process that harnesses compounding to work for you, even when you are sleeping. By focusing on the income floor, you ensure that your basic needs are met by the internal mechanics of the companies you own, rather than the external luck of a bull market. Building this engine requires more than just picking stocks with the highest yield. In fact, chasing yield traps is the fastest way to lose your principal and your future income stream. You must look for companies with a moat, strong balance sheets, and most importantly, a sustainable payout ratio that ensures the company isn't stretching itself too thin to pay you. A sustainable payout ratio, typically below 60% for most industries, means the company still has plenty of cash left over to reinvest in its own growth and weather any economic storms. Diversification is your second line of defense. You want to own pieces of the economy across tech, consumer goods, energy, and real estate to ensure the cash keeps flowing consistently. If one sector hits a rough patch, your income from the other 10 sectors remains stable, acting as a natural insurance policy against the unpredictable nature of the global industrial cycle. The strategy should be automated. During your working years, every cent of dividends should be funneled back into the market to acquire more income-producing soldiers for your growing financial army. Once you reach your retirement goal, you simply flip the switch from reinvesting to distributing, allowing the cash to flow into your checking account without ever selling a single share. This pivot is seamless and tax-efficient, as you are not forced to liquidate large positions all at once, giving you total control over your taxable income and your long-term legacy. You should also prioritize dividend aristocrats or kings, which are companies that have increased their dividends for at least 25 or 50 consecutive years, proving their incredible durability and resilience. Selecting these elite businesses ensures that your income engine is built with the highest quality components, designed to run for decades with minimal maintenance and maximum reliability for your family. The shift you must make is psychological. You have to stop obsessing over whether your portfolio is worth $1 million or $900,000 on any given Tuesday morning. Instead, you must obsess over whether your portfolio generated $5,000 in income this month and whether that number is higher than it was this time last year. This shift in focus provides an incredible emotional freedom. When the market crashes, you actually get excited because your reinvested dividends are now buying shares at a much cheaper price. You are no longer a slave to the green or red screen. You are a business owner, focused on the productivity and the profitability of the assets that you have spent years accumulating. Knowing that your lifestyle is funded by the actual profits of global commerce provides a level of peace that a fluctuating savings account simply can never offer to a nervous retiree. Take control of your financial future today by moving away from the hope and pray method of selling assets and moving toward a build and collect system of dividend growth. Your wealth should work harder for you than you ever worked for it. It should be a reliable, predictable machine that generates abundance regardless of who is in the White House. The 4% rule was a noble attempt at a different time, but in the modern world, ownership of cash flow is the only true form of financial independence and security. Start looking at every dollar you invest as a permanent worker whose only job is to go out and bring more pennies back to the hive every single quarter for you. By building this bulletproof income engine, you aren't just saving for retirement. You are creating a financial legacy that can support you and your family for many generations to come. We have covered why the old math fails, how dividends provide real-world security, the superior math of cash flow, and how to build your own diversified, high-quality, income-producing portfolio starting today. The path to a stress-free retirement isn't found in a spreadsheet of projected returns, but in the steady, rhythmic arrival of dividend payments into your brokerage account, month after month. Now that you understand the power of shifting from capital depletion to income generation, you are already ahead of 99% of investors who are still stuck in the old way. To help you get started on this journey, I have prepared something special that will help you identify the best companies to form the foundation of your own personal income engine. Would you like me to analyze a specific list of high-yield stocks to see which ones are safe bets and which ones are dangerous traps for your retirement portfolio?